anyway, I moved on from Powell's and moved to a company called Django's. Django's Music and Movies. Django's was a small record store in downtown Portland. The person sold to a serial entrepreneur who went to raise money, and the number wasn't 14, it was actually $19 million. And we raised and went through $19 million in about 18 months, so about $1 million a month. So those were interesting times. Again, 2000, right at the peak of the dot-com bubble, if you will. And it was very interesting going from Powell's to Django's, because at Powell's we had to think twice about spending even $100 on advertising. And at Django's, the objective was to grow as fast as we can and money be damned. So we were spending. I would sit there going, oh my God, is this really a sustainable business? And our entire business model is predicated on raising additional rounds of funding. And that taught me a very valuable lesson. Don't ever do that. Try to work with what you've got and not anticipating what funds you will get in the future, because that may never come, because you can never predict the future. And sure enough, that's what happened to us. 2001, the dot-com bust, and we ran out of money. So I left Django at that point, had no option but to leave, and started a company called Monsoon in Portland. There were 3 of us, 2 folks who used to work with me at Powell's and Django's. And I learned a lot from my previous 2 experiences. So the thing I learned the most was that we do need capital to grow, but it needs to be used judiciously. And you need to be sized it appropriately and take cash at the right time. And more importantly, the capital needs to be raised for growth purposes, not to survive. If you're trying to look at money, raising money to survive a business, I would strongly encourage otherwise, because that's not a good business model. You need money to really fuel growth. Ran Monsoon, started Monsoon in 2002, raised a little bit of angel money in 2005, and I'll get to that in a bit. And finally, last year, sold to a private equity group called Oak Hill Capital. So let me talk about my sources of funding and also what I believe are the various sources of fund, traditional and other sources of funding available today. So financing options, right? When you look at options, a lot of people talk about banks, bank loans or SBA-backed loans, lines of credit. These are usually asset-backed, so you need to have some kind of collateral for this. It traditionally is less expensive than other options. By that I mean, yes, you will be paying interest, but at the same time, you're not giving up equity. And if you're running a really good company, you want to protect your upside. So you want to make sure that you keep as much of the company as you can. They generally don't interfere in the day-to-day running of your business unless you're in deep trouble and then they call you every day. But outside of that, they're traditionally hands-off. And of course, you've got the danger that you would lose your asset. If your business is unsuccessful, you would lose your asset, your primary asset. And for most people, that happens to be a house. So you do run that danger. And again, today it's a tight lending environment. So I'm sure the bankers in the room can correct me if I'm wrong, but I think it's pretty hard to get access to capital. It's not as free as it was or free-flowing as it was 2-3 years ago. And I'm sure we can talk about that a little more when we have the panel. However, there's a big misconception, I believe, that banks don't lend to startups. I was looking at some data. There's a gentleman named Scott Shane who's written a book called The Illusions of Entrepreneurship. And he mentioned that 53% of companies 2 years or younger are financed with debt. And 16% of all the financing to these companies are through banks. So there is money out there. But at the same time, you've got to make sure that you've got some collateral to back it up. As far as my experience with banks goes, at Django's, we did have a line of credit with a bank, which we promptly proceeded to use up all of it. And so it wasn't pleasant. We would have these weekly meetings to give them a status on our fundraising, and it definitely was not a pleasant experience. So when I was at Monsoon, I was a little gun-shy of this, sitting in those conference calls week after week, kind of wears you out after a while. So I was a little gun-shy of taking any kind of loan. So we bootstrapped Monsoon. We would pitch an idea to a customer, and if we would build it if they paid for it, because that's when we realized there was value in what we were doing. However, it came to a point where we said, yes, we can accelerate the business a little more, and we needed to pay for some contractors. So we went talked to the bank. We talked to Bank of America then, and we got an SBA bank loan, a back loan. We had to pledge our homes as collateral. This was 2002, early 2003. We had to pledge our homes as collateral, which we did. It was nerve-wracking. I had to go tell my wife that. Do you think this is okay? And she was fine with it. And that, again, is another big lesson. Whenever you're starting a business, make sure your spouse or your partner is behind you 100%. You need to have that commitment. And that's absolutely important because at the end of the day, you go home, right? And you've got to make sure, that you have a good nurturing environment at home. So we did use that. That helped us a lot, helped us to hire contractors and move the product forward and generate more revenue. Later on, after I raised some angel funding, we used to bank with the Silicon Valley Bank. And we decided to go ahead and get a line of credit even though we didn't need it. We figured that was the best time to ask a bank for money, was when you don't need it, because they will be willing to loan you money then. So we did set up a line of credit with Silicon Valley, which we didn't really touch. We never used it. But it was a big relief having that in the back of my mind, knowing that, yes, if we do find the right opportunity, we do have access to capital. And that helped us a lot. We had to pay some fees, of course, and we never used it, so some might consider that the fees we paid for a waste, but in my mind it wasn't, because I knew that I did have capital, so I could utilize that if I needed to. So we had to go through some reporting requirements every month. It was a little onerous, but once you do it the first 2-3 times, you get used to it. And it worked for us. Like I said, we never did touch it, but just having that is one, as an entrepreneur, just knowing that you have some capital to tap into if you need it, it's a big relief. Raising capital takes up so much time when you're an entrepreneur that if you can set that aside and proceed to run your business, it works wonders to your morale. And so that was good. But again, the hard part is being disciplined to say that you're going to touch that money only when you absolutely need it. And that's a big part of being an entrepreneur, which I think a lot of people forget, is being disciplined about capital. Most people, and I've seen this over and over again, raising capital is a sign of success. They assume that raising capital is a sign of success. And that's not necessarily true. People walk around saying, I raised 2 million, I raised 10, I raised 100. Big deal. It's what you do with the cash. It's what you turn that cash into is a lot more important than how much money you raise. So you've got to be very, very disciplined as to how you spend that money. The other options, financing options, equity-based. This is where I've traditionally gone. A big part is, again, you've got no assets as collateral. Your home is underwater. So what do you do? Where do you go? If you're a seed stage or early stage, like Jim mentioned, angels. Angels are the initial source of funding for a lot of businesses. The good part is your interests are aligned. You do have to give up some equity. And depending on how much cash you need, what stage your business is, how confident you are, that's all negotiable. You start with friends and family. That's the first place you hit. And if they trust you, they give you the money. And then you broaden your network. And that's where it's really important to network, to go to as many of these events as you can. My personal experience has been, it took me about, let's say I started in November 2004. I completed my round in August 2005. I took part in Angel Oregon, the first Angel Oregon. I raised some money there. And then I went through a dry spell about 4 months where I didn't raise any money. And then August of 2005, as our business started showing traction, we raised our entire round. We actually were oversubscribed. We set out to raise about 1.2 million. We raised close to 2 million. And a little over $1 million of that came in less than 30 days. But again, that was because I was persistent and I kept chasing dollars. You've got to keep following up. You've got to be very, very persistent. They're more apt to be silent partners. Again, this is my personal experience. And I think there's a difference when you have a successful liquidity event and when you don't. For me, it was all good. My angels, some of the folks I've never met. It was through phone calls, some of them via email because their friends invested, they did end up investing in my business. And a big part of what I learned in this process, when I started raising money in late 2004, I had a big offering document. I had a 100-page document, and I think just one person read the entire thing. In fact, he's at Mount Hood Equity right now, Milt Mittelstadt. He was the only one who read through 60 pages of financials and asked me a question on page 78 or something like that. But outside of that, most angels don't know your business. They don't know all the details. And really what you're selling is yourself. What they're banking on is you, the entrepreneur. Can they trust you with their money? That's what they're looking at. They don't do as much due diligence as venture capitalists. So a big part of what they're banking on is you. So when it took me about 5 months to realize that. And once I did that, my selling process became a lot easier trying to raise capital, and I think that was a big part of the success. What I have seen, there is definitely less risk tolerance on the part of angels too, as in the past, as in the height of .com bubble, it was, well, if I didn't get in, the deal could slip. I think there's a lot of really good educational work being done in Oregon today. Folks like Edco, folks like Jim, both the Jims actually, Jim Coonan and Noonan, and with OEN, I think they're all doing a wonderful job of educating angels as to the investment process, which is very, very good. One of the big challenges, though, is that it's hard to find a lot of angels in Oregon. And I believe a big part of that is because there's really a lack of first-generation entrepreneurial wealth. And let me explain what that means. Entrepreneurs are more likely to fund entrepreneurs. So you've got to have a lot of successful exits before those folks, because those are the guys who are willing to take the risk. Because a lot of the time what's being pitched by angels by early stage companies is just a concept or an idea. And you need someone who's got a high level of risk tolerance. And until you have the first level of entrepreneurs who have had successful exits, who do understand the entrepreneur mindset, it's hard to raise capital. And I think that's one of the big parts where Oregon's at a disadvantage. We haven't had a whole lot of big exits. We've had very few companies like a Microsoft or an Amazon or Real Networks or Google, Yahoo, Facebook. We've had very few of those. All those companies have spawned dozens of millionaires who are all willing to risk because they've been through the startup experience. And we've had very little of that in Oregon. And I think that's part of our challenge. We are doing a lot now to change that. I think that's the biggest. If I was to pinpoint one area in Oregon where I think we need to do more, it's finding that initial stage capital. And it's really somebody who's willing to put $50,000, $100,000. And we realize that. I think the OGA realizes that. I know a lot of organizations are working towards that. That's where, there's a strong network of groups, like I mentioned. You've got OEN, you've got TIE, you've got OAF, you've got the Portland Seed Fund. It started in Portland because that's the biggest cluster here in Oregon, but it is moving to other areas. So you've got the Bend Venture Conference as well, which Jim mentioned, and the OGA this year has decided to invest in every venture angel conference. We will match up to $50,000, and some it's less, some it's more. But so it's really building that early stage funding, which a lot of folks need, and where there's nobody to provide that funding, because banks traditionally don't lend based on pure ideas because there is no collateral there.